Hi, good evening, ladies. We're looking at chapter 11 in Making Markets Work, theme 4, and this is the narrated PowerPoint to cover that subject. That's basically on page 57 in your theme 4 booklet, and this is the narrated PowerPoint that goes with that, basically. So yeah, without further ado, let's get cracking then. So we're looking at market failure across the economy and some of the policies that can be used to try to deal with market failure. So some of this will be a little bit of revision, I think, probably, but also hopefully some new content which will help you to understand it too. So let's take a look at it. Let's get started. Okay. So obviously we're talking about a range of things which lead to or can lead to market failure, and that's in some cases it's to do with merit and demerit goods. Social costs, social benefits, and also public goods. And we're going to be looking at that in a little bit of detail and looking at some of the policy options that are available to try and deal with market failure. So let's take a look at some of the areas we're going to cover then. And let's move me over a bit so that it's a bit easier for you to see the content rather than me. It's a bit dark in here actually, as you can tell it's been shot in the evening. I will just put the light on slightly more, I think. That's a bit better, still looking a bit ghostly, but there we go. So what we're going to do is look at these following topics then. The provision of public merit goods, as we mentioned before, indirect taxation of demerit goods, tradable pollution permits, provision of information, legislation and regulation. So these are all different policy options that the government might choose in order to try to actually prevent or deal with market failure, which clearly is going to lead to a poor allocation of resources. So that's the whole principle behind it. So we're also going to look at the impact of these policies on the economy and society, both long-term and short-term. And let's get straight into it then. Okay, so we're talking in most instances about government intervention to try to address these market failure issues. So in this instance, we need to discuss some of the reasons why the government chooses to intervene, and also whether they should or not. There's an argument to say that we should leave the market to just deal with any of these issues, and the free market will finally sort of even itself out and find an equilibrium point. However, that might then mean that certain goods that we think might be a good idea to provide may not be provided in quite the right way, and in some instances the short-term view of profit maximizing businesses and organizations might not necessarily choose to provide all of the services that we might like to in an advanced society like the one that we live in. So clearly, in some cases, the reasons for this intervention, one might be to reduce or eliminate negative externalities. That's something we talked about in the last couple of chapters we've looked at. Could also be to increase or maximise the positive externalities of certain products and services. Certainly could also be used to increase the supply of merit goods, and again we'll look at merit goods and also demerit goods in a minute, but also to reduce the supply of demerit goods where there is a social cost over and above the price of the good involved. Also supplying public goods that might be undersupplied by the market. So if the free market was left to its own devices, then in some cases some public goods may not be provided, although they may be a very good reason why they should be provided. So let's take a look at some of the reasons for government intervention in markets. Then generally it's to support UK industry, and obviously one of the things that will drive this is the macroeconomic objective that the government has, or the government or the economy has. In this instance, obviously one of the ones, and we're going to go through a couple of examples and show how this objective might be achieved and why the government might then choose to intervene in certain situations. Okay, so if we accept that full employment is a government target, then certain industries are going to be more important than others as they employ large amounts of labour. And clearly in that case, the government is likely to try to encourage those industries to employ more people where they can. And in some cases, they might provide incentives and also a range of other things. Now, there are a couple of links that I'd like you to take a look at. one which is to do with should government support industry, and also infrastructure in emerging markets. But one of the issues around other reasons why the government might choose to intervene is because infrastructure is a very important part of business, and if they're going to supply goods and services and high quality services, then obviously having the infrastructure to be able to do that in terms of transportation and communications is clearly going to be quite an important thing. So let's take a look then at another example then. So in this case, maybe if we're looking at ways in which the government and what the reasons why government might intervene, could be to reduce inequalities in the distribution of income and wealth. So clearly, if we think about this, unequal distribution of wealth and income can lead to poverty, relative poverty rather than probably absolute in this country. And clearly, if we don't address that sort of thing, we're going to get tensions in society. They can be quite a difficult thing to deal with, and in some instances, you know, if that tension then leads to unrest and possible riots, etc. It doesn't sounds dramatic, but it doesn't take too much of a leap to go from tensions into all-out disagreement, and in some cases, essentially unrest, I suppose, and violent unrest in some cases. So, thinking about this and taking it to its nth degree, then there is potentially going to create a breakdown in society, which could cause and lead to even further market failure. So, in lots of instances, the government might try to intervene to try and make things slightly fairer, if you like, for want of a better term. Okay. So let's take a look at the sorts of things, or I want you to have a think about the ways in which the government might choose to intervene in the future. And more often than not, it's probably going to be to try and address some of the social issues and some of the issues that obviously we're talking about an awful lot in this day and age, like climate change and also inequality of income and dealing with poverty, etc., etc. So. Excuse me, let's have a look at some of the other things that we need to bear in mind then, okay? So clearly, if the government has a certain objective that it wants to try and achieve, then there are some impacts on both the economy and society of these types of policies, okay? And if we take a look at what these are, clearly, if we're talking about economic growth as a key objective, then to some degree, the policies that need to be in place are going to be to try and encourage job creation, to try and create jobs. If that is achieved and if economic growth happens, then that normally means that people are getting higher levels of income. If there's economic growth, that means that there's more demand for products and services. That means that firms will need to supply more goods and services, and that will mean that hopefully more people will be in better paid jobs, and so we're going to get rising incomes. That's going to clearly lead to improved standards of living. If we've got more money in our pocket, we're more likely to spend it on consumption, and that's going to mean that hopefully the standards of living and the standard of goods and services that we're buying will be significantly higher. Clearly, if we're providing goods and services that are of a better standard, that should mean that if we're being more efficient and we're producing and innovating and inventing new products, etc., that clearly is going to mean that we're going to become more internationally competitive. So UK firms will become much more competitive on the international stage. That's going to improve the confidence of consumers to spend, businesses to invest, and as a result of that, that clearly is going to almost be a self-fulfilling prophecy. So that's just going to encourage the growth to keep going and keep improving. Okay. Now, if that happens, if all of those things happen, if the policies that are put in place have helped for that to be achieved, then there's an argument to say that the government will have lower spending on job seekers allowance and associated benefits and universal credit, because there are more people in work and there is less requirement, less need for the government to spend on benefits and the welfare state. And clearly, again, thinking about the impact that would have if we've got more people working, more people paying income tax, more businesses being more successful and then paying corporation tax on their profits, well, tax revenues are likely to increase as a result of that. And that's going to allow government to reinvest in infrastructure and spend on public services, which is just essentially going to make things even better and improve things in order to keep this process going. And that's why economic growth is seen as a very important way of improving not just how well off we will feel and how well off we all are, in fact, but also it's going to help to improve the overall level of the economy, and hopefully some sort of economic development will lead from that as a result. So in terms of what happens and how the governments might choose to intervene when it comes to then correcting market failure, let's have a look at some of the things that that they might choose to do. Might choose to look at particularly the provision of public and merit goods, and we'll take a look at what that means in a minute and how you can define each one of those. They might choose to also indirectly tax demerit goods to make them more expensive to buy and to try and discourage people to consume as much of the demerit goods as maybe they would like to. There are other examples like tradable pollution permits, which we'll look at in a bit more detail, where effectively businesses are incentivized in some ways to not pollute, and the way in which that works is quite an interesting principle that we'll take a look at in a minute. The provision of information, so in some instances where maybe there is asymmetric information and people don't necessarily, or consumers don't necessarily have the full story, this might mean that the government will provide that extra information to be able to make, for consumers to be able to make more rational decisions in their purchasing decisions. Might actually choose to use legislation, so acts of parliament, so that if somebody doesn't choose to do what they're being asked to do, then there is legislation and a law that they can bring to bear, which might mean that anybody that's flouting that law will get sued or prosecuted. And then obviously there is regulation as well, so regulation of markets to make sure that, again, market failure is not going to happen. So let's take a look then at the provision of public and merit goods then, okay? So the view is that in some cases where the free market isn't going to provide for certain public goods and services, then the state will often intervene and actually provide it itself. And generally speaking, that's going to be where those services are merit goods or public goods. And the government chooses to intervene because they want to ensure there's an adequate supply of those goods and products and services is available to the market, okay? And clearly, in some cases, some of those things, there are going to be added benefits and add-ons and improvements as a result of that process, okay? So state provision of those types of services and public goods are clearly a very important part of the whole process, okay? Tends to happen when the government believes that this product is either a merit good, so for instance, the government supplies goods and services like state education and health, and the NHS obviously is a very important example of that, and that's where effectively the belief is that if it was just left to the free market, then maybe there would be an under provision of those merit goods, okay? If it's just down to how much profit can we make out of that particular thing, if that's the only thing that's driving the decision making, then that might mean that the market mechanism, the free market mechanism, isn't going to necessarily provide the level of merit goods that maybe we all need as a society. The other example is a public good, okay? So things like defence and infrastructure, okay? So if it were just down to the private sector, then effectively, if those roads and networks and defence weren't provided, then again, it's likely that in some instances they're not going to be provided to the level that we would maybe want them to be if it was just down to the private sector. And that's, again, one of the main reasons for the government intervening in the free market mechanism to provide those things. Let's take a look at some of the ways in which we can then deal with demerit goods then, okay? So we talked about demerit goods, we haven't, although we'll look at those in a bit more detail. So these are things like alcohol, cigarettes, fatty foods, gambling, things that are considered to be not necessarily of a very high merit, okay, hence the term demerit, okay. Now, in some instances, clearly, too much alcohol, too many cigarettes, too much fatty foods, and too much gambling is basically not very good for anybody, is it? So, in this instance, what the government chooses to do to try to discourage the consumption of demerit goods is to use a form of taxation, okay. So they will either tax people's spending, and also to some degree they will also use the tax system to try and control the economy, okay. And in some cases they will do that directly, and in other cases they will do that indirectly. Excuse me. So an indirect tax is basically a tax on a good or a service, okay, whereas a tax is a tax on an individual or an organization. So and we've looked at some of these previously, but in some instances when you're actually being encouraged to or discouraged in this case to buy demerit goods, the incidence of the burden of tax is the amount of that tax that is paid by the consumer or the producer, who have to pay that burden effectively. And we'll look at that in a little bit more detail when we come to look at the way in which we presented this information in a graphical format. Okay, so the drawing that you can see above, or the graph you can see above, is basically the way in which taxation is used to try to discourage the consumption of demerit goods. Now let's just run through and go step by step through this to explain what we've got going on here then, okay. So if we look at this as an example, okay, we're assuming that this is a demerit good, and in this instance what we're saying is that we are actually imposing a tax, an indirect tax, on the demerit good, which will lead to an increase in the cost of supply for a firm, okay. So that would mean that this would move supply curve upwards and to the left. So the original equilibrium, market equilibrium, was at S and D, where we were talking quantity Q and price P. Now, in this instance, effectively, what that will do is, by causing the extra cost, the cost of production, to go up for our supplier, that's going to shift the market equilibrium, in that's now going to be the supply curve, but with added tax. Okay, as you can see, effectively, in this instance, we've moved supply curve up to the left, and as a result of that, we have now got a new market equilibrium where essentially we've got a lower amount of quantity being provided, and also the price is at a higher level. Okay, so in that instance we should see two things. Okay, one is the quantity supplied. Sorry, we'll go back one. Let's go back one. Oops, daisy again. And in that instance, clearly the price has also increased. Okay, now that should, by the very nature of the way that things are happening there, should mean that, number one, the quantity of the demerit good will go down, the quantity demanded will go down, and also the price is going to go up. So the price, the increase in price caused by the extra tax, has caused an overall increase in price, and that's meant that demand has fallen slightly. Okay, now in this instance then, okay, you can see the increase has caused the price to rise by the vertical distance between the two supply curves, as you can see. That has a significant change. Now, the incidence of the tax paid, or the amount of tax paid for by the producer, and the incidence of tax paid by the consumer, is basically the difference, as you can see, between the original equilibrium, market equilibrium here, and anything below that original equilibrium is the extra amount that the producer is having to pay, or the incidence of the tax that the producer is having to pay, and then anything below the new equilibrium point to the point that we've just described, so the old equilibrium point, is basically the consumer is actually paying for that extra amount, essentially, by having to pay that extra cost. Okay, so let's take a look then at the next thing. So hopefully that makes reasonable amount of sense. And clearly, in this case, what we're trying to do is to discourage the consumption of demerit goods. If we then look at different types of taxation, then, so we've got two types of taxation that can be imposed. One is a specific tax, which is the one that's dealt with in the first diagram, and then we've got an ad valorem tax. Okay, and the basic difference is that a specific tax is where you have a set amount per unit of quantity that is being charged on each unit of the good. Okay, so for instance, if we took the fizzy drinks tax or the sugar tax on fizzy drinks, then in that instance, what we were saying was, or what we could say is that the example here could be it's a tax of 50p per fizzy drink. Okay, now if we were going to show that, that specific tax would basically be exactly like we showed on the previous example, where there would be a parallel shift in the supply curve. So it's not that the amount of tax doesn't vary, it's charged at the same price, at the same level on each of the fizzy drinks, and hence it's a linear parallel shift in the supply curve. Okay, so the tax increases the supply curve from S to supply with tax, and that obviously does exactly like we showed in the previous example, shifts the quantity demanded to Q1, so makes the less quantity being demanded, and that's partly because of the higher price. Okay, now if we have an ad valorem tax, that's basically where a percentage of the price of the good or service is charged as an extra. Okay, and clearly that would mean that as goods became more expensive and as products become more expensive, then if it's a percentage, then clearly that means that there's a greater amount of tax charged on the more expensive product. Okay, so in this instance, where we're talking about an ad valorem tax, the shift in the supply curve would also be upwards, but it's also tilting, as you can see. Okay, so same sort of principle, but in this instance, because the price is increasing, in this case the price is increasing as we go, then the level of tax is also increasing because it's a percentage of the overall price that is being charged in tax. Okay, so important to be able to distinguish between those two. Same principle, but in this instance, obviously, as we get into higher prices for the goods or services, then essentially the level of tax actually also increases. So that makes it even more expensive in terms of the taxation burden. Okay, so let's take a look then at another example. So we looked at some demerit goods and using taxation to try to deal with the over consumption of those products and trying to manage that process. But let's take a look at another tool that's used, and that they are called tradable pollution permits. And I think we maybe touched on this in the last PowerPoint, I believe. But basically what this involves is providing a sort of incentive to business on a global scale to reduce CO2 emissions. Okay, now this is quite controversial in some ways, because what it's saying is that in some cases people will, or businesses will, pay a certain amount to be able to pollute at a certain level. Okay, now one could argue that that is actually, isn't that surely encouraging pollution? Well, not really. No, it's not, because you have to pay for them in the first instance. But what you can do is, if you don't need them all, you can then trade those pollution permits, so you can literally sell them to others, and then obviously you can benefit to a higher level as a result. Okay, so in this instance, what we're trying to do is to reduce negative externality. So clearly the externality in this case is pollution, and that's clearly dangerous for all of us for various different reasons, and obviously clearly the climate and also the environmental pollution. So in this instance then, this clearly is due to a number of things, I suppose. Maybe it's the recession, but and in this case, EU production has fallen, so there's been a less pollution due to the fact that we haven't been as economically active, I suppose. However, that has had an impact on this principle as a way of actually trying to manage pollution levels. Okay, so in this instance, that clearly you could argue is maybe not working in the way that we'd ideally like it to. But let's go through the process of how it works anyway. Okay, so basically pollution permits allow firms to produce a legal level of pollution each year, and it's an agreed level that they can actually, and these permits, they are tradable on the market. Okay, so if a firm doesn't use all of its permits, it can sell them to other firms that pollute above their allowance. They clearly are going to have to pay a significant amount of money for that, and so they are getting punished. And clearly, it is a punitive system, but it's not saying it's what it's trying to do is to try and encourage people to be honest and say, yes, we are polluting, but we will, I know, and we will get charged for it, but we have an incentive to try to beat our targets and not use our permits because we can actually then trade them back. And that creates a financial incentive for firms to reduce pollution. And trading schemes seek to reduce CO2 emissions globally. So it's a global principle, this, and that is starting to get some fairly serious traction. It's clearly quite difficult to assess the amount and levels of permits to provide to firms. And again, one of the things that we would hope is that as businesses become more sustainably aware and more about sustainable development, maybe they will, by the very nature of that process, start to look at the levels of pollution that they're creating in terms of their carbon footprints, etc. So if we take a look at how this might work then, okay, and we try and show these tradable pollution permits in graphical form, okay, let's just take a look at what this means then. And that effectively what we've got in this case is, if we have these tradable pollution permits, okay, the government could choose to enforce stricter pollution control by reducing the number of tradable permits from Q to Q1. Now, clearly, if that were the case, that would actually then influence the level of supply, because if you've got less option to, or you've got a smaller amount of pollution permits available, that's going to cause the supply curve to shift to the left, okay? And in this instance, that's going to lead to higher prices and a higher cost to firms creating the pollution, okay? Now, clearly, in this case, the government could issue fixed amount of pollution rights in the economy. And so as a result of that, the supply is perfectly inelastic in that it can't change, okay? It can't change, and as a result of that, there is a maximum amount of quantity that can be demanded, if you like. So that is not going to change. If we get to that situation, let's go back one there, sorry. If there's an increase in demand for pollution permits, the legal right to pollute, then demand will shift from D to D1, okay? And it will make those tradable permits increase in terms of the price, okay, that they're being charged. Now, there aren't any more tradable permits, so effectively all that will happen in this situation is that they will become more expensive. And one could argue that if that happens, then that is going to mean that we've got less pollution going on, because people are going to find it even more expensive to do so. If they do want to, as we said before, firms will either have to pay more for the right to pollute, or they might be, hopefully more importantly, incentivized to reduce that pollution. And for those who don't need their permits, they can sell them on the market. So it seems to make some sense, this, although it might seem a bit weird that you're not actually rewarding businesses for polluting. What you're doing is incentivizing them to reduce their pollution. And if they do that, they can get an incentive of some cash by selling back some of those pollution permits, if that makes sense. Okay, so let's take a look at the next thing then, okay? We've talked about asymmetric information quite a lot over the past few weeks. And clearly, when businesses and individuals have a lack of information, sometimes they're not necessarily going to be able to make the best decision because of a lack of the relevant information. Now, in some cases, the government will step in and help with that. And so both economic units, when we're talking about both are those that produce the goods and services, so economic agents like firms and businesses, but also when we're consuming goods and services, that also in some cases may not necessarily be based on the full information that we need. So where that fails, where the private sector fails to do this, the government will step in and provide this extra information in a number of different areas. So for instance, it might be the job market, it could be dangerous products and keeping people aware of how dangerous the likes of cigarettes are in terms of creating other smoking related illnesses, and also some economic data that helps firms to plan for the future. So that might be based on the government looking at forecasts and where they think that interest rates might go in the future via the information that they can get from the Bank of England, and present that to firms, and also maybe looking at other sources of data which are going to give some sort of idea of where the economy might go in the future. So all of those things can be done by the government to try to reduce market failure. Next thing that they can look at and do, clearly use an awful lot, is legislation. So that's where we're creating, or the government is actually creating laws and enacting laws in order to protect individuals, firms and society as a whole. And there are a whole range of examples. Now, in this instance, these legal environments are basically collections of or the legal environment is a collection of acts of parliament and laws that have an impact on the activities of organisations and other members of society too. Okay, so clearly that is a good way of trying to encourage further control, and in some cases, obviously, if it's actionable, then in this instance, clearly those people who are choosing to flout those laws are likely to be sued or prosecuted. So if we look at regulation next, then, okay, so it's another form of government intervention that is about trying to avoid market failure. Okay, so if we think about how regulation might work, to some degree, if we're regulating a market, what we're doing is looking at where there might be some inefficient allocation of resources, or there might be some market power that is being exploited to some degree, and regulation is about trying to manage that and bring effective competition into markets. So this is where effectively the government will undertake certain activities and create incentives to try to create competitive markets. Now, we've talked about the advantages of competitive markets, particularly where you've got high levels of market power or monopoly power. And in this instance, bringing in competition is likely to reduce prices to consumers. It's going to mean less exploitation. It's going to mean greater choice, and also likely to mean more innovation in efficiency in markets that in the past may have been just not needing to, because they're the only game in town. So in this instance, it's really about trying to protect the interest of consumers and not allowing any exploitation by firms. And clearly, effective regulation, decent levels of regulation, should lead to greater choice and lower prices. And that takes place in a number of different industries. Funnily enough, in lots of industries where in the past they were in public ownership, so the government, they were state-owned monopolies, if you like, in telecoms, water and energy. And over the period of time where those have been privatised, some of the regulation has actually been put in place to try to encourage greater competition, and also to make sure that we get better choice, lower prices, and are not getting exploited by big organisations that have got lots of market power. One of the main reasons for that regulation is to create conditions that allow for continued investment in infrastructure and important parts of the economy. So clearly that regulation process is a two-way street, really. If you've got more regulation and you've got more businesses, more competition, then the likelihood is that should mean a more competitive environment, and that is going to benefit all concerned. So a few questions to check your understanding. So one of the key reasons that the government might intervene, with some choices there for you to consider, and then choose one and then try to explain your answer. Another quick test where we're looking at the government subsidy. You might need to look back at your subsidies work where the supply shift curve has been caused to shift. And essentially a subsidy in this case is the opposite to some of the direct or indirect taxation. So that's where the government is trying to encourage the consumption of a good or a service, and in that instance is actually offering an incentive to encourage further supply. Other options, looking at things that a government might choose to do to try to encourage a greater supply of merit good. Have a look at the options there, and then again see if you can explain your answer. So let's take a look at some typical examples, exam-based questions on policies that attempt to address market failure. Now, this is there's quite a list of them here, and I'm not intending for you to do all of them, but at least if you've seen these types of questions, then they're not going to phase you, essentially. Okay. Now, what we're also going to think about then is maybe using this as a means to sort of check out your understanding as well. So, the sorts of questions you might get asked: to what extent can regulations be used to correct market failure in the fast food industry? Well, there's an example, a to what extent question. Okay, we've clearly got to understand what regulations are, how they might be used to correct market failure in general terms, but also how they might be able to correct market failure in the fast food industry. So you might choose to focus on the healthiness of those particular food outlets. Another example: to what extent is the provision of information through health warnings on cigarettes the most effective way to correct market failure in this industry? Again, to what extent always means that you're going to some degree, give a balanced argument. Okay, another example: to discuss the extent to which a subsidy to producers of organic fruit and vegetables might increase their consumption, thus generating positive externalities. So again, trying to unpick what the command words are in that question, and also the things that you will definitely have to discuss based on the way the question has been structured. Next one: discuss the extent to which pollution permits are the most effective way of correcting market failure caused by CO2 emissions. So cover some of the stuff we've covered in the previous slides. Another example: discuss whether the indirect taxes on air travel should be increased. And another one: discuss the extent to which all healthcare should be provided privately. So there are a number of questions, and each one of those is essentially asking a question in a certain way. So understanding what it is and planning that process would clearly be a very good thing to consider. Okay. Now, one of the things I would also say in a situation like this is where you can use a diagram to analyze your answer, to illustrate your answer, then that's clearly a very good thing to do, because again, it demonstrates that you really understand the process, and you can not just demonstrate it by putting a nice structured argument together in your response, but also demonstrate what the implications are and show them graphically. And that really is a very strong process to go through, and will help you to gain extra marks. So let's take a look at other things that we mentioned previously about the impact of policies on certain parts of the economy. Let's have a look at, in this case, on both the economy and society, of having an objective of low unemployment. Well, clearly, in this instance, if we can generate higher demand for goods and services, that should mean that effectively we are going to have more people wanting to buy goods and services. That's going to mean that more firms will want to employ people to satisfy the extra demand, and that should then lead to more people being employed, and hopefully they will also be on higher incomes. That's going to mean improved standards of living, and that's then going to mean higher levels of tax revenue for government, because more people in work will mean more tax will be gathered. And also, if we've got improved standards of living and we're spending more, that essentially is also going to generate even greater growth, and then more requirement for people to work in different occupations. It's clearly going to lower government spending on employment-related welfare, because more people in work means that actually the government hasn't got to spend some of that tax revenue on paying for unemployment-related welfare. It's clearly going to improve the productivity of the UK economy, and that obviously is then also going to some degree, help to reduce poverty. It's not going to eradicate it, but clearly, if that is the case, that more people are able to work and are getting paid more than they were getting paid previously, that should help to reduce poverty. Clearly, other social benefits include reduced crime. If people are actually better off and earning more money, maybe they won't need to turn to crime. And also, there's some improved well-being, maybe based on the fact that you're actually doing a decent day's work for a decent day's pay, and you feel much better about yourself. And so there's all sorts of potential benefits for that, from that. Any of this process, any increased spending, could have an impact on merit goods, because some of that spending, that based on the fact that the government has more money to spend because it's got lower spending on unemployment related welfare, and also hopefully is gathering more greater tax revenues, might mean that education and the NHS will benefit as a result of that. So again, it's helping in all sorts of different ways to try to improve matters and also economic development for a country. We take a look at low inflation as a key objective then. So in this case, what we're trying to do is just demonstrate this chain of reasoning, this principle of, right, if we've got low inflation as a low objective, what sort of impact is that going to have, and what sort of policies are there going to be put in place to help achieve these and the effects it might have on the economy and society. So if we've got low inflation or as a target, the reason that we try to, or the government and the Bank of England try to control inflation, is that clearly if inflation, so an increase in prices causes an issue in terms of the value of money that you might have in your pocket, then workers' wage demands are clearly going to have that they're going to be wanting more money, and also to some degree it's also going to affect consumer confidence if we've got high levels of inflation. If we've got that situation, it damages the real value of money and it erodes anybody's spending power. And that clearly is the reason why, in this case, the government has an inflation target that is set at 2%, but that is actually administered and managed by the Bank of England rather than by the government. So the government gave the Bank of England that target, and basically it's their responsibility to make sure that that target is achieved. Okay, so in some cases, if we've got high levels of demand, if we get reduced demand, that's going to impact inflation and it will reduce inflation, but it might mean that we get less spending on merit goods as a result. So effectively, you can see that whenever we're talking about these examples, there are always there's some analysis to be done, but also there's going to be some evaluation too. And hopefully you can see that this starts to develop that skill to answer the higher level, higher tariff questions, that the 20 markers, for instance, where you're having to put together a plan and also then try to evaluate that as we go, making a couple of points and evaluating it, giving a balanced response, and also then coming up with a judgment that can justify your conclusion. So that's what we've covered in this last presentation. So that's covering chapter 11 in your booklets from page 57 through to page, hold on, 62, I think. Yes, through to 62. So hopefully that makes some sense. I know some of this is revisionary, but hopefully that has given you some good examples, and hopefully in terms of preparing yourself for the longer questions that you might be faced as and when you are assessed, should that happen. Okay, so thank you for listening once more, and we'll be in touch very soon.